Good morning to everybody joining us today for our Challenges Facing Manufacturing in 2023 webinar. Apologies that we're just a few minutes late in starting while we were waiting for some others to join. I'm very grateful to you for investing your time in this webinar, and I hope that you learn something that helps to improve your own company's performance in some way during 2023 because of this. Forewarned is most definitely forearmed in a challenging business environment. That is what this webinar is about. We have studied the data points, plotted the trends, and given you our opinions on what to expect in 2023. There are no guarantees here, but there has been an awful lot of research done. We are proud of our forecasting record from previous years. My colleagues and I have spent considerable time researching content for this webinar over the past 3 months. We have more sources than we're able to mention here. However, these sources include, amongst others, the London Metals Exchange, Bank of England, IMF, ONS, OBR, EU, the Financial Times, InnovateUK, the Manufacturer magazine, MakeUK, and gov.uk. To ensure I report the facts correctly to you, I should be reading from a pre-prepared transcript. To start with, let me introduce myself. I'm Cliff Brereton, CEO and founder of DataHone, a manufacturing software and systems provider based in Leeds. My career history includes being an apprentice toolmaker, press tool designer, computer salesman, professional manager and director at IBM UK, director of HM Government Data Science Laboratory, professor in the School of Engineering at the University of Liverpool, and founder of DataHone Limited. I've also several non-executive posts and activities, including being a manufacturing industry advisor to the Bank of England on interest rate policy. It is a broad mix, though through this I am well qualified to talk about manufacturing and the importance of data to this industry. In the interests of time, let's press on to talk about some of the cost and supply challenges we as manufacturers might or probably will face during this coming year. Everyone on this call knows the significance of the manufacturing sector to the UK economy. No first world economy can deliver the programmes and services needed by its citizens without a significant proportion of the national economy being made up of export-orientated manufacturers. Some of the numbers relating to this sector are truly staggering and often well underestimated even by those of us in the sector. These particular numbers come courtesy of 2022 MakeUK BDO survey. In the small map graphic to the right hand side of the slide, we show the sector mix for our home county of Yorkshire and Humber, the second largest manufacturing region in the UK. There are some regional differences in the makeup of the sector, typically with materials and chemicals trading places in some regions with one another. Once again, the most heavily publicised and visible increase observed starting as far back as late 2021 is energy costs. Most of us are large consumers of three-phase 415 volt power for machinery and ancillary support services such as compressors, computing equipment and back office functions. We observed in 2021 a hike in electrical charges per kilowatt hour from 19 pence in January 2021 to a new average of 27 pence in 2022. The average tariffs for January 2023 were 33 pence, representing a 74% increase in just 24 months and 32% for the last 12 months. For those of you in the process manufacturing industries, or those just using it for heating factories and offices, gas costs are also a significant consideration. In the same 24-month time period, per therm costs for gas increased from £60 through to £210 12 months ago, and have now dropped back to today's price of £130. During the past 12 months, this price hit a peak of £613, and the average for 2022 was around £350 per therm. We anticipate Q2 gas prices above £250 per therm. Over the past several months, businesses have benefited from an £18 billion government subsidy scheme for gas and electricity. This current support scheme ends in March and is then replaced by a new scheme, the Energy Bills Discount Scheme, covering the new financial year through to April 2024. This new scheme at £5 billion pro rata offers around 1/6 of the current scheme in relief to industry. The UK has finite generation, supply and storage capabilities for energy. Because of this, we will continue to have significant price fluctuations based on the supply side being near imbalance with demand. A recent scheme actually paid customers during peak times not to use electricity. Such are the limitations of the UK power generation. Furthermore, limited competition within the energy market on the supply side does not help to provide competitive stability for tariffs. It is difficult to imagine how we have ended up not having a coherent national energy supply strategy other than through negligence or mismanagement by successive UK governments. Overall, we expect energy costs and the consequential impact on margins to be higher in 2023 than the past year, partly due to reduced reliefs, a higher starting tariff, and also the volatile energy market, which presently is providing prices significantly below their 24-month peaks. Furthermore, availability of power in certain circumstances might become constrained, although we only ascribe a low possibility to this happening. One energy source that we left out of the previous section was oil. The UK has strong manufacturing industries in plastics and pharmaceutical products. Both of these sectors have highly refined petrochemical inputs as a critical source of raw materials. Oil costs are significant to the overall cost of sale for companies working within these sectors. A barrel of Brent crude averaged $110 per barrel through 2022 and peaked the year at $130 per barrel. Currently, a barrel of Brent oil costs $87, which is near a 12-month low, though that is still 45% higher than January 2021 prices. Geopolitical uncertainties create significant fluctuations in oil and oil-based commodity prices. We expect to see significant volatility in the oil price throughout 2023. The cost of copper, which is considered an economic barometer due to its versatile uses, has seen its cost increase in the past 24 months by 12.5%. It is a better picture looking at the 12-month compare, with the current price of copper being $500 per tonne less than a year ago. Aluminium is following a similar trajectory to copper, with increases over 24 months and flat over 12 months. We do expect to see added volatility for aluminium during 2023 as Indonesia, one of the largest producers of bauxite, has banned all exports of this mineral in favour of selling processed aluminium. Steel is now mainly being supplied from Turkey, China or India. There was significant volatility in steel pricing through 2022 due to geopolitical issues. This saw the price per tonne of steel rebar peak at $970 per tonne during the early summer. It has, however, come off of that price significantly and has remained relatively stable at around £700 per tonne since the autumn. Any further diplomatic geopolitical issues, particularly with China, would see the price of steel rocket and possibly result in a scarcity level for steel that will make a proportion of British manufacturers no longer sustainable. We continue to hear of supply chain issues mainly being attributed to either COVID, Brexit or Putin. It is indeed true that the prosecution of each of these has not helped supply chains. We have at points in the past 12 months seen scarcity in metals, steel in particular, and microelectronics components, amongst other things. Microelectronics has seen shortages over a much longer period and they still exist today. We at Data Home use many microelectronics components within our products. Standardisation, making volume procurement and optimal production possible, has given way to multi-supplier policies, product redesigns, and thereby increasing costs, just in order to get hold of parts. Global supply chains are great when they work, and the incentive for these has been cheap and abundant parts and supplies. Scarcity has brought about a rethink on the wisdom of entirely global supply chains. Re-establishing a local supply chain may be an opportunity for growth within the sector, reshoring some of the supplies, though this will come at a cost as local suppliers won't have the volumes for price matching giant global suppliers. However, we do not have businesses if we cannot obtain the parts and materials we need to process. This reshoring will of course only be limited, as restoring a steel industry, for example, is not something that can be done overnight or perhaps even at all. The former Chancellor Rishi Sunak, in his financial forecast for 2022, predicted inflation at 4% for the entirety of 2022. In this webinar last year, we suggested it would be nearer 10%, and so it turned out to be. The current Chancellor, Jeremy Hunt, advised in the autumn statement in November that inflation had peaked at around 10.5% in 2022 and will fall to 2% by the end of 2023, giving an average inflation of 7% for the whole of 2023. We suspect that this forecast carries similar levels of unsupported optimism as that shown in the forecast for 2022 by the now Prime Minister, Mr. Sunak. February inflation figures were announced yesterday and came in at 10.1%, a step in the right direction, but not significant and not on a trajectory to meet the Chancellor's forecast. Remember, inflation rates are compound. Even were the Chancellor correct and we do get much lower inflation by the end of 2023, prices will still be upwards of 30% higher than they were 24 months ago. In order for prices to go back to similar levels to 2 years ago, we would need deflation, and that has never happened in the UK, nor is it particularly welcome for business. Our research, application of statistical analysis tools, and conversations with manufacturers would suggest that achieving an inflation figure of 6 to 8% by year end would be a more likely outcome. It is also worth noting that most consider any reductions to be made primarily through reduced demand side pressure from slower sales performance and not significant reductions in energy and raw material costs. So it's not an entirely great outcome. Inflationary pressures will remain for our workforces and their families. This is likely to put pressure on payroll and add to existing difficulties of attracting and retaining skilled staff. The International Monetary Fund takes a similarly downbeat view of UK economic prospects in 2023. In its latest World Economic Outlook, published on January the 31st, the IMF has downgraded its forecast for the UK's GDP in 2023 from minus 0.3% to minus 0.6%. According to the IMF, every other country in the G7 is expected to have positive growth in 2023 and only the UK recedes. The UK is already second bottom of the productivity outputs of the G7, according to the Bank of England. So it is not unreasonable to make a firm correlation between poor productivity and poor growth in challenging times. By any measure, the UK certainly needs to improve productivity outputs. We believe that inflation will be higher than the government projects in 2023, perhaps significantly higher. Things will certainly cost more in 2023 than they did last year. There will be zero economic growth measured over the full year of 2023. Corporation tax rates will increase for the year to April 2024 from 19% to 25% for all companies earning over £250,000 in profits. Below this figure, companies remain at the previous rate of 19%. This one will undoubtedly impact UK business investment and international inward investment in the UK manufacturing sector. Investors will naturally seek lower tax environments to make their investment calls. On top of this, the popular super deduction tax scheme, providing 24 pence in the pound of tax relief on capital purchases, ends in April. This is likely to make investment in new machinery and automation a more difficult one for companies to make. The reversal in November 2022 of the earlier 1.25% increase in Class 1 national insurance contributions is of course welcome and should make overall national insurance costs less for the next financial year than for the past one, where 6 months was charged at that higher rate. Overall, the tax situation in 2023 is less favourable than 2022, with reduced reliefs and increased rates. According to a recent MakeUK BDO survey, the average age of the UK manufacturing sector workforce is 51. This is the largest single threat to the sustainability of the UK manufacturing sector. Perhaps after this webinar, take a look at the averages within your own organisation. Many manufacturers tell us that recruiting good skilled workers is incredibly difficult. CNC machine operators are just one example here. We could devote an entire webinar to the skills development area. What is clear is that schools are not promoting manufacturing as a worthy career, and universities are generally providing a poor level of engineering education. One particular employer in the aerospace industry told me recently that he was not able to hire a single graduate from a School of Engineering cohort at a Russell Group university due to their fundamental lack of even the most basic engineering skills. This same employer runs a vibrant apprentice scheme. They see this as their best route to workforce sustainability. Whereas previously machines were often the finite resource, in many instances now it is operators. This challenge has at least brought some constructive new thinking and adoption of new automation technologies such as robots, cobots and our own machine monitoring software. We expect access to skills to remain a challenge for years to come. Make sure that you are the employer of choice. This skills shortage will inevitably put pressure on payroll and drive the need for new investments in automation technology. A major change we have seen in our research compared to earlier years is the fall off in demand side confidence. This does not apply to all manufacturers, as we have customers who have never had a fuller order book, but typically this is due to a competitive takeout rather than growth in their markets per se. So for every winner, there has often been a loser in the sector. What has been good to see is that in many instances, manufacturers have been able to pass on their additional costs to their clients. This has insulated the sector a little, though we suspect there will come a point when not all of the costs can be transferred to the price. The main factors impacting the demand side are confidence. The Purchasing Managers Index, the main bellwether of economic confidence, has the UK currently at 48.5%. 12 months ago, this figure was 59.9%, a substantial drop year over year. Below 50% represents a contraction, and the current figure is even below that of some of the months during the 2020 pandemic. Cash and credit. Some businesses are now looking at their cash in the bank more as a rainy day fund than investment capital. Interest rates on borrowing have risen from 0.25% 1 year ago to 4% now, making the cost of borrowing for investment significantly more expensive. Inflation is eroding investments and purchasing power. Unemployment, though officially not significant in the UK, remains a concern to many consumers. Currently at 3.5%, it is expected to rise to 5% by year end, according to the Office for Budget Responsibility. Ford announced a 19% reduction in its workforce just this week, taking nearly 2,000 jobs out of the UK manufacturing workforce. Manufacturing job losses are not restricted to traditional manufacturing roles such as car making. British Volt, a company much promoted as an example of the new British green manufacturing jobs, went into administration in January with losses of £120 million after consuming large amounts of government financial support. The company had promised 3,000 direct jobs at a gigafactory in the northeast of England and a further 5,000 jobs in their supply chain. I'm pleased to be at the end of this somewhat depressing list, although let's be clear, it's actually far from exhaustive. These cost factors alone are endemic and are applying a squeeze to your manufacturing margins. Using the general rule of what goes up must come down, we should expect ups and downs in costs throughout the next 12 months. 2022 certainly told us that. As a benchmark, currently energy is at the top of the near-term cost range and raw materials are currently near the bottom. The geopolitical situation will govern much of what happens to these costs in 2023. The cumulative impact of these rises and others I haven't mentioned depends very much on the type of manufacturing you carry out and which materials and commodities you use. So there is no average squeeze across the sector, but a span. For 2023, our forecast cost increase for manufacturers is between 7 and 12%, with some outliers above or below those numbers. If you are in the fortunate position of being able to reprice and continue to pass your additional costs onto your customers, then you're going to be somewhat shielded from margin erosion in 2023. The pricing strategy, however, could impact your competitiveness, and threats from others might emerge to erode your revenue lines. You need to be a competitive predator and not the prey in a contracting market demand. You will create this competitive edge by optimally using your machine assets and staff in the most efficient manner. Technologies such as our own intelligent factory and other automation products will secure this high productivity for you. We spoke earlier about manufacturers having record order books in spite of difficult trading conditions in 2022. As growth in the economy was practically zero throughout that period, this increase in orders must have come at the expense of others who have lost business. Price, of course, is not the only consideration for buyers, but it certainly plays a key part. The winners and losers pretty much shared the same cost models for energy and raw materials. So the differentiator must be how well the assets used to produce the parts were run. When I look at the winners, they have newer machines, more automation, robots and inspection stations. They have sophisticated manufacturing systems, including machine monitoring and predictive maintenance. The message seems clear. Invest in technology and automation and you will see returns in competitiveness and margin. We were surprised to see that your customers had absorbed your additional costs in many instances. This has afforded the maintaining and or increasing of margins. Continue to do this cost to price transfer, and if costs drop, maintain your prices on your existing accounts for more margin and reduce your margins in line with your costs to win competitive accounts. Here are the key takeaways from our research. Expect us to be at least 80% correct on these recommendations and forecasts through 2023. We have spoken a lot about increasing costs resulting in margin erosion or competitive pressures, but it is really essential for all of us to concentrate as manufacturers on the costs that we can control versus those we can't. There is almost no point in spending your efforts on things you can't control, but 100% of your efforts on the things you can, resulting in improvements to margin performance. Let's now look at a typical profit and loss account for a manufacturer. But before we do that, we asked an SME manufacturer to give a few thoughts on how they saw 2023 shaping up. I'm grateful to Martin Chisholm, Operations Director at Farat ISO Level, a specialised manufacturer and supplier of highly engineered precision products for the construction industry. This interview with Martin took place earlier this week.
Okay, well, I'm Martin Chisholm, and my role within Farat ISO Level is as Head of Operations. And what Farat do, we are a solutions provider. So we will take your acoustic, stroke vibration and thermal insulation problems and solve them engineering-wise. So we'll come up with an engineering solution that would help you isolate a building, help you from vibration, help you isolate sort of theatre auditoriums from each other if you've got a number of theatre auditoriums, and help you sort of with the insulation of the building, so there's no thermal transfer, for instance, across RSJs, as an example. Yeah, I think the challenges are well known. We're still suffering the repercussions of supply chain volatility across all our supplies, both inbound and outbound, just in terms of material availability, but also the sort of the vibration, for want of a bad way of putting it, of the costs. So steel costs massively rose last year, have dropped quite dramatically. Concrete costs are all over the place. So costs and cost control is a problem. And then actually getting hold of stuff can be difficult. Now we're not like using anything sophisticated like semiconductors, but even just your some of the standard fairly high-end materials that we use for our products can be quite difficult to get a hold of. We were getting quotes that were used to be six week lead time, we're pushing out to 6 months. That's got better again, and we don't have that problem specifically today. But I envisage that potentially happening again, that volatility across the supply chain. Obviously, manufacturing in its entirety is a very heavily engineered, energy-reliant industry. We, in particular, looking at from our experience, we're very much energy hungry. We're heating great big platens of steel to mold rubber, and we're using, cutting with high pressure, 4,000 bar plus water jet machines. Again, all using a lot of energy. So energy costs are significant for us. The jump in energy prices last year did cause us some issues, and the removal of the cap is going to cause us some further issues, but we are planning for that as best we can in reality, and some of that is through efficiency savings. Obviously, with the data home system now just up and running, we can look at, and in fact just yesterday we were looking at, there was a machine sat idle all over the weekend. It was draining some power. It was sat, it was like having your engine, your car idling over the weekend. What can we do to stop us having to do that? And that's again, we got that information from the data home info, sensors. So that enabled us to start to look into that and see what we need to do to allow us to prevent that from happening again, and save a little bit of energy and save a little bit of cost.
My thanks again to Martin, and now let's get back to that profit and loss account. Sales revenue less cost of goods sold, or cost of sale, equals gross profit. In this case, 5.9 million of gross profit was generated by 16.5 million pounds worth of sales, leaving a very healthy gross profit of 36%. UK manufacturers on average range from the high teens to the late 20s in percentage terms for gross profit. To deliver this revenue and gross profit, the company spent 10.5 million. But on what? Typically, there are three distinct elements to cost of goods sold: raw materials, direct labour, and what is known as factory overhead. Included in this overhead is rents for the factory, machine depreciation, and energy. In this particular example, we have moved energy out of the factory overhead to show it discretely alongside raw materials. Based on what we heard earlier, there is little we can do to control either energy or raw material costs, which represent 50% here of our total costs. On the other hand, the labour and assets are entirely within our control. If we can operate these assets more efficiently, maximising the uptime of the machines, improving the throughput and reducing scrap, then we can begin to take large chunks out of our cost of sales. This in turn will feed through to more gross profit. Typically, companies that have focused on these productivity issues have seen an overall reduction in their costs of 8 to 12% and a consequential similar increase to their gross profit numbers. The takeaway here is to concentrate on what you can control and not what you can't. If you need any help realising these asset and labour usage improvements, do talk to me about the Data Hone Intelligent Factory. Before we conclude and wrap up, here is a short video talking about the Data Hone Intelligent Factory.
Dr. Peter Drucker, who is described by Businessweek magazine as the man who invented management, said in 1956, "You can't expect to manage what you don't measure." When we look at the manufacturing value chain, all revenues are generated within the factory environment, other than the occasional small after-sales activities such as warranties. Yet the shop floor is often the least served in terms of information management. Most organisations have a payroll and HR system, financials, CRM, stock management, and even MRP and ERP. But the assets generating revenues, such as the machines and labour, are often served with paper-based, inaccurate and untimely reporting processes. Even benchmarking is impossible from this type of reporting, let alone real-time situation management. At Data Hone, we visit manufacturers like these every single day. Most will tell us their factory floor is 60% effective, yet many barely make 40% in reality. That means that for 60% of the time, those assets are generating no revenues or profits, yet they are incurring costs in labour, power and depreciation. Sadly, the UK is a poor performer versus our international competitors in the productivity stakes, with good reason. The good news is that by using accurately collected and automated data reporting in real time, a chunk of that lost effectiveness can be returned to revenue-generating productive activities. The result is that you can produce more output with the same assets, or the same output with fewer assets and costs. Either way, manufacturers become more profitable and competitive, and margins increase. Data Hone Intelligent Factory provides an interconnected mesh of IoT interfaces, sensors and devices that extract vast amounts of data from machines and factory environments. Edge computing and cloud-based advanced analytics make sense of all the data and deliver that back in seconds as actionable knowledge, insights and updates to drive optimal manufacturing performance via intuitive dashboards and alarms. Even when you're not at your desk or in a supplier meeting off-site, Intelligent Factory can send you an email, SMS, or even WhatsApp with the information that you need to know, when you need to know it. Intelligent Factory connects to any machine of any type, manufacturer or vintage. So whether you are putting ketchup in bottles or pills in blister packs, moulding, packaging or machining parts for the latest Airbus, Intelligent Factory will tell you what is happening and when it is happening, so you can intervene where necessary and optimise your machines, your labour and your work order throughput. The Intelligent Factory is delivered by Data Hone fully turnkey. You just have to use it to increase your productivity. Return on investment is measured in months and has been independently verified as being 4 times that of investment in a new machine. If you're still fiddling with paper and spreadsheets and feel your productivity has room for improvement, Datahone's Intelligent Factory is for you.
We're coming to the close of our presentation. It's been my pleasure to host you throughout. I hope that the information that we have shared with you will help you mitigate cost increases, perhaps through actions such as forward fixed price ordering of energy or raw materials that will give you known price and near assured delivery. All of the information shared during this webinar will be shared in our annual Challenges white paper. Soft copies of the white paper will be shared with the email addresses you provided when registering. Hard copies are available upon request. Both soft and hard copies will be available at the end of the month. The recording of this webinar will be available on YouTube tomorrow, links to which will be posted on the Datahone Company LinkedIn page. Finally, whether or not we are facing headwinds in 2023, the right thing to do is to improve the bottom line for your stakeholders by optimising efficiencies. Looking at this favourably, this is more profit to invest and reward. Less favourably, just remaining competitive. The Datahone Intelligent Factory is the foundation stone of creating the most efficient and productive factory environment. Contact me on the email address shown and I'll give you some examples of how we have worked with other manufacturers and transformed their manufacturing performance. Have a successful 2023 and I look forward to speaking to you when we do this all again next year. Goodbye.